mortgage expert. Today we're going to be speaking about interest rates and loan pricing. Lenders use risk-based pricing to determine the interest rate and discount points that they'll charge you. Today I'm going to explain the basics of this risk-based pricing and give you typical lender practices and procedures in determining your interest rate, costs, and everything associated for mortgage loans. First off, what is risk-based pricing? Risk-based pricing is a system that evaluates the risk factors of the mortgage application, credit profile, and it adjusts the interest rate and or discount points up or down based on risk evaluation. So what are the factors that can affect this pricing? Various factors that affect the pricing include credit profile, which is the amount of debt you have outstanding and how you've historically paid that debt. The credit report will also contain what's known as your FICO score. This ranks your actual credit history, and this is given by 3 repositories: Experian, TransUnion, and Equifax. The next factor is the property itself. The type of mortgage you're mortgaging also impacts loan pricing. For example, an investment property, a condominium, or multifamily housing, these are usually considered to have a higher risk to lenders than a single-family home or a detached home, which makes this more risky for the lender. The final major impact is your actual income as it relates to your debt. This is known as your debt-to-income ratio. This is the total amount of your mortgage payments plus any monthly payments you have on your credit report as compared to your income. The higher your debt-to-income ratio is, potentially the higher your interest rate's going to be and the higher your fees may be. Now that we've covered this, let's talk about how and when your price and rate are determined. The rate is determined by evaluating all these risk factors that are involved in the loan and then determining where you fit into the lender's risk price range. They use a matrix. Remember, risk-based pricing can change from an initial estimate that you're given based on the initial information you gave and at the time you actually close your loan. When you actually lock your loan in, that's the interest rate you have. However, due to rules and regulation changes over the last 5 years, banks are required to now pull your credit right before you close, check your job right before you close, and so on and so forth. If any of these things change, your final risk level is determined at that point. And that's going to give you your end rate and your end pricing. It sounds a little wishy-washy, but that's why we tell you to keep everything the same as you're going through the process. So how can you obtain a lower interest rate if you fall in one of those higher brackets? If you're currently not in the lowest bracket available, you may be able to obtain a lower price or rate and lower your risk by putting more money down, lowering the LTV, which is the loan to value. You can clear inaccurate items off your credit report or pay down some of your debt or lower some of your debt. This will also decrease your debt-to-income ratio. If you're doing a refinance, you can go from a rate and term refinance or a cash-out refinance and switch that around. Or you can just change the term of your loan. I hope you enjoyed this video. If you have any questions, give me a call. And don't forget to visit our website at www.mortgagesiny.com. I'm Criscuolo, and I'll see you next week.